Started. Perfect. Good evening, everyone. Welcome to another fantastic webinar event. We'll give everybody a couple of quick seconds to join. Well into the triple digits this evening, and we certainly appreciate everyone's time in advance. And everybody can still see my screen, Jason, Charles?
You're
We're good.
looking good, brother.
All right. Well, let's jump in, guys. We have a truly incredible content tonight. We're going to keep things really brief. As a quick note, the chat is open. Please let us know what part of the world you are coming from this evening. In addition to that, Q&A is open as well. So we're going to cover some KPIs and cover things from about a 10,000 foot level. And couldn't be more excited to have our guest speaker here with us tonight. Charles Loretto is the partner and the second most tenured partner, as we were discussing. So since 2001 with Cain Watters and Associates, which if you haven't heard of Cain Watters, it truly is one of the go-to dental office accounting firm, which is incredible for the clients. It really appeases to a very business-minded type of dentist, as well as Charles has worked with over 3,400 dentists, speaks across probably even more than I do across the continental US and Alaska and everything else. So Charles, thank you so much for joining us, sir. Greatly appreciated. So with that being said, also joining me on our team that oversees and was just in Cain Watters and Associates office and with the elite team is Jason Yim, our senior consultant here at Cirrus. Thanks for joining us, Jason.
Absolutely. Pleasure to be here.
All right, guys, so let's jump in. So truly appreciate everyone's time. Just to quickly customize, we've done, obviously a bunch of these over the years, and we always want to get some great co-speakers. So we want to just customize it tonight a little bit based on your situation and specific. So a couple of questions that Charles was wondering is, are you tracking any of your KPIs today? What the heck is a KPI? Key performance indicator. Are there, or is anyone on your professional team, accountant or otherwise, showing you key numbers to track, right? How do you know if you are at above or below averages and or success ratios? And most importantly, is there a pathway to help get you there? So tonight we really wanted to leverage some of the data. So all new content for this evening, if you've joined us in the past, it's really about data, knowing your data, and also how do you help to change the relationship with your CPA, right? If they're not challenging you, should you be challenging them? I know personally of it. I look at the invoices each and every year and I say, what am I really getting other than some tax advice? I would really love to have someone dig into those numbers and say, right, what should be common, what is a success, and how we can build off it. So let's jump right into that. First of all, myself as the owner and president of Cirrus Consulting Group, all PACE certified this evening, and CEs will be processed within 10 business days for all the attendees. So data, not just for Star Trek anymore, but really it all starts with the data. So part of what we'll touch on tonight is we track over 95 billion square feet through our license data. Plus, in 32 years in business at Cirrus Consulting Group, right, with over 13,000 successful projects under our belt, the proprietary data becomes key to understand what should be fair and reasonable as it pertains to the financial expenses. When we talk about expenses, number one is obviously staff. We've got some great courses coming up with Dr. Mendelson and Ben Derrickson and Prosperident coming up next month. But for this, we really wanted to touch on, most importantly, the second biggest expense, which is the tenancy expense. Then Charles will go through some other key pieces on your profit and loss statement. But even looking at where I was last week in San Francisco and Los Angeles, etc., knowing rental rates, knowing vacancies, and seeing how you compare is key. So the first main piece that Jason and I and the rest of our team here at Cirrus have the pleasure of doing is to help advise our doctors to say, look, where are you at in terms of revenue as it relates to tenancy expense? Now, Charles will touch on a lot of ways to help drive more production and help to yield better ratios. We want to look at it from those with the potential rent problem. And even if you own, we'll touch on the importance of having the lease in place, but this is just a really good best practice. When we look at, a clinic that's for example, paying 90,000 a year, 1.1 million worth of overall revenue and collections. That puts you at about 8.18%, rough math. National average, we see about 8.32%. So obviously major urban areas, etc. We want to get that as close to 6 as possible. And working with your advisors, Cain Waters, etc., can certainly help point to that. But really, as we approach the rent problem, part of it is to say, Charles, look, how do I know if I'm overpaying in rent or not? How do I know what's fair or reasonable? So deep diving just on this one little rabbit hole is, first of all, there's so much more than rent, right? When we look at the tenancy expense, as you can imagine, it's not just base rent. Most doctors focus on the first half of the first page. And of course, there's 55 and a half other pages of other stuff in there that can impact tens, if not hundreds of thousands of dollars. So when we look at it, really it involves looking at the lease. What is the base rent? What is the annual increase? We've seen some landlords ask for 4 or 5% annual increases across the board. Things like common area maintenance. Gosh, Charles, I can't believe how many times the doctor, signs a binding letter of intent and, thinks that the total amount is 30 bucks per square foot and suddenly realize, oh my gosh, what the heck is CAM? Who's CAM and why am I paying an extra 15 bucks per square foot, right, for this taxes, maintenance, insurance, snow removal, etc. Then there's other pieces that's interesting. For example, did the doctor or the previous doctor take money from the landlord, such as tenant improvement allowance, right? If the doctors suddenly, or the landlord or the landlord's broker or your broker suddenly suggested, hey, why don't we take 30, 40, 50 bucks per square foot, right? Doesn't sound bad, and in many cases isn't. But don't forget, the landlord is not in the lending business. So what's shocking now is over 54% of dentists are overpaying in rent. Yet you, doctors, are the best tenants on the planet. You've got the highest build-out costs, you've got the lowest default rate, you're in the same location for 26 and a half years on average. Default rate of a dentist is less than 0.5%, right? And you can't work from home and you're always bringing in high quality foot traffic. So why? Why are so many doctors dramatically overpaying in rent? Part of it is taking a bunch of tenant improvement allowance upfront. And that's why if it increases at a higher the rate and every time it renews every 5 years, you're on the world's most boring roller coaster. The other thing that we see a lot of is just the process of renegotiating the lease. The best time to start a lease renewal is 2 years prior to the lease expiry. And we'll go through some examples. When does the average doctor start, Charles? I'd like to say 2 or 3 months, right? And in many cases, it's just too late. The landlord knows it's going to be 18 or 24 months to pick up and relocate a clinic in Frisco or anywhere else across the country. So these are just some of the little variables that you can try to squeeze as much out of your next lease renewal to keep as much money into your bank account as possible. So, Jason, you've had the privilege of coming down. You presented to a bunch of the clients through Elite and Cain Waters, etc. Maybe share a little bit about the due diligence and the prep work you do and what you do through the process of looking at the specific building reports and analysis for your doctors.
Yeah, absolutely. So as you can see on the screen here, this is a little bit of the behind the scenes of how we determine what your situation looks like as far as the rent. And frankly, from your perspective and also the landlord's perspective, they're going to be looking at this as well. They're going to be looking at things, for example, such as net absorption rate, as in who's moving in versus who's moving out into a space. We look at vacancy. So, what if for those that are looking at potentially renegotiating where they're at, if there's a high vacancy rate, there might be an opportunity to squeeze the landlord to make a better deal. Because on the flip side, one of the big things that we look at when it comes to vacancy rate is if you actually need to find a new space, there might be a lot of potential out there. So there's a lot to discuss there when it comes to that. Also, in terms of what else we look at, in terms of, for example, base rent, this is going to be obviously one of the big ones that we'd be looking at in terms of what you're paying today, as opposed to what you potentially could pay should you decide to leave or should you decide to renegotiate. If we can move on to the next slide here,
Yeah.
what, mhm.
Yeah, so just as a little sort of deep dive. So all of it is hyper specialized and localized. So I just did some quick reports here using our licensed software, but even here, not too far from where Charles is tonight, just ground floor retail in a strip mall type plaza. There's over 2,000 properties with 3,881 spaces currently for lease. We can dig into each and every one of these and then Jason, maybe dig in a little deeper in terms of what you look at and how you help assess if that doctor is in fact overpaying, and if so, by how much.
Absolutely. So, in terms of the overpaying piece, we certainly want to look at the area, subject property. What are people paying roughly in the plaza? What are people paying outside the plaza within buildings of that particular type? And then as a market overall, what are people paying? And then, of course, on top of that, the base rent alone is not going to tell the only picture. We certainly want to look at other pieces here. For example, things like, again, net absorption, market asking rent, and what the trends are regarding that. Many of you will have a year-on-year increase in your base rent. Well, what does that look like today compared to the rest of the market? That's definitely something we'd look at to determine, okay, what's your current situation look like? If you can go on to the next slide here.
Yeah, so
Mhm.
maybe just to add here, and Jason, roughly 39% own, and Charles, from your question earlier, 42% are tracking KPIs, 58% of those on thus far are not. As we'll dig into those. So, literally, through this software we leverage as part of our lease reviews we do for our clients, all of this represents live data and a historical 5 year, 10-year type of trend. So, again, if the landlord treats us like we were born at night, that may be fine, just not last night. So, even when looking at historical averages, we can start to see dynamically what in fact is the numbers and the data telling us. Now, no data is perfect, but it definitely helps to reinforce it. And then to those of you that own, the next question is what's separating the real estate corporation from the practice corporation? A great conversation to have with Charles and his team to look at all the potential options by those of you that own versus lease. But even if you own, the next question is are you paying yourself rent? Right. In addition to that, what about liability slips and falls, etc.? Or, right, have you created a lease that would allow you to sell your clinic tomorrow? Meaning, heaven forbid, if you were to pass away, is there a lease structured to separate the real estate corp and the practice corp that is very landlord friendly? And if so, is it based on fair market rent? Now, you can certainly leverage the great CPAs at Cain to help assess, again, what should be best to minimize the tax perspective. But always starting with the facts helps to really make sure you've got a good perspective. Lastly, Jason, again, for doctors thinking of that second location and or, when we think of KPIs, we're thinking financials, P&Ls, but really part of it is what's the data and the indicators based on the demographics. What are some key pieces there, Jason, you do to help
Yeah,
doctors on the driving results?
certainly. So when it comes to the demographic piece, this is absolutely huge well, frankly, for those that are looking at a second location, but even those that are looking to remain in their current one. One of the big things that we take a look at is, well, let's call it your piece of the pie. We'll look at population. We'll, get an assessment of what's the area growth look like? What's the household incomes look like? What's the projected growth of the population for those that are targeting a particular demographic? What's that look like within the area? Are we looking at more of the 18 and under pediatric clinic type of crowd, or are we going to be serving more of the working age type of individuals? These are important pieces here when it comes to the demographics. Also, one of the key ones that we look at is, when I talk about the piece of the pie, many people want to know, okay, what's my market really look like here as far as spending overall? What do people really spend in the area? And one of the big ones here that we can highlight is that healthcare spending piece. You'll see here within that particular area, you'll notice that there's a certain amount of household spending, and that's a good. That'll give you a good assessment of what people are willing to um, what people's priorities are at when it comes to being in this particular area, or if you're looking at outside, if you're looking to establish a new location to be there 5, 10, 15, 20 years, these are going to be really important to know.
So as you work with your advisors and your professional team, right? Certainly I know visiting the Cain Water's office, amazing walking in, all the doctors' names and lights. They came in, flew in for an annual review, etc. Part of what we do to assist clients and your advisors at that stage is to get some of this background data into those hands. So even looking at health and personal care, and even from a business plan, within a 2-mile radius of this exact doctor's building is a $10 million market on health and personal care. A neat little button here that, all the tens of thousands of dollars I pay for this software, it also then combines and estimates and all the AI and machine learning behind the scenes, but it's going from 10 to 12 million, right, between 2024 and 2029. So bottom line is, and let us know if you have any questions here, Charles, and we'll get back through it. But bottom line, it's a great opportunity in terms of knowing some of the core numbers, traffic volumes, right? Really getting a different perspective of the building, and then important to see those data points and then helping to work with your professional team to grow that and or leverage it to make sure that you're not overpaying in that particular rent. Perfect. Excellent. So, one of the key pieces there is start with the facts, start with the data, right? Looking at this other example here, I mean, look at this. They're offering now 8, 9, 10 different spaces in that mall at $24 a square foot. If that doctor is paying $32 per square foot and suddenly the space next door is being advertised at 24, you're not going to have a happy doctor, right? And whoever signed this lease, we can even see what other tenants are paying in the building. And we can see that one was 48 per square foot. Now, because of all the vacancies, they're offering 24. It's almost half. That obviously doesn't happen every day, but it does go to show with, 89% leased, landlords move and you want to certainly ebb and flow with the market. Thoughts or questions, Charles? I saw you unmuted there.
No, I'm honestly just fascinated. I mean, this is just really good data. I mean, that's exactly what advisors at the firm look is data. If it's a dental supply, what it is for an implant cost or the biologics. It's good data to have. It's good data to have if I'm renting a you know um, 2,000, 3,000 square foot. Like you said, it's going to be one of the largest or will be the largest fixed costs that we carry. So prior to signing a 10-year lease, 120 payments, you want to make sure you got the most competitive deal at the right time. And obviously, I think even most importantly, it's not just about it, but it's how to get in and how to get out of the deal. So making sure you got a good legal agreement to protect you as well as to exit as well. And I really liked your comment as well about the 2-year thing. I cannot emphasize enough how what I think that the commonality between tax planning and renewing a lease. I mean, you call me up on the 31st, or you call me up today on October 15th and say, "Hey, I just filed my 1040 because my CPA just gave it my final number. What can you do for me?" Nothing. It's a year ago. But if I know you're going to build a space and I know we've got a year or two or planning, I've got a window, then man, it gets exciting because that ability to plan. So you're doing great.
Appreciate it. And you still took the words right out of my mouth is, doctors look at the lease a little differently, and it does. It represents the biggest check that you will sign in your personal and professional lifetime, full stop. Again, where do we fit in? It's pretty unique, right? We're never paid for by the landlord, so always follow that money. That's great, great advice that Charles mentions as well. Who's paid for by whom? Is it a flat rate? Is it being paid for by the landlord? Is it baked into your rent, right? We're never paid for more based on the more the doctor pays. And again, if you're signing a binding letter of intent or otherwise, in some cases before anyone else even has a look at it, right? In the landlord's eyes, the deal is done. So we've had the privilege of servicing clients now for over 32 years, and really still the only healthcare specialized tenant advisory lease negotiation firm of our size and scope over the decades. So again, waving the white flag here, what should it do for you? Well, first of all, you're right. We don't just want to exercise that 5-year option. In many cases, Charles was saying, some cases a longer term lease, starting that 2 years in advance. By starting the process early, the landlord says, "Oh my gosh, why is Dr. Loretta reaching out to me? I wonder what the process is. What's wrong? Is he thinking of moving? Gosh, they've hired Cirrus, right? Maybe they're going to relocate. Gosh, we don't want to lose them." The landlord, you'll never believe it, but trust me, in many cases, they need you more than you need them. So be conscious, right? And help to make sure that you've got a long-term lease. The other big piece, I was down in Newport Beach recently doing a big CE course with the Dental Mastermind group. And what we found was ultimately, again, doctors weren't leveraging their leverage, and also were typically just renewing the leases. And the banks reiterated, look, we cannot issue a long-term loan for your buyer if there's insufficient term on the lease. So if you're of the camp that thinks, Charles, you know what, I'll just run my lease out, or I'll go month to month and I'll figure it out down the line. The second you talk to a practice broker, they will say you should have created a 10 to 5 year roadmap to a practice sale, and definitely have as much term and options as possible, unless you're just going to sell the charts and give back the keys, right? You really want that lease to help maximize those practice sale proceeds by helping to make sure that the buyer doesn't have the risk that they're going to get kicked out or redeveloped or relocated in the mall. The other big thing I would suggest is having a death and disability clause. So again, the same thing for the 42% of you that own your buildings today. This is just as important, right? What are the fair and affordable rents going to be for your buyer? When you plan to sell, do you plan to keep your real estate as a passive form of income? If so, at some point you will become a full-time landlord, and therefore you will need to have some form of a lease in place. Therefore, if you're going to have it, I was just in San Francisco, one of the doctors of the reps there had just passed away in his mid 40s in his sleep. Devastating, right? The question there is, where's the lease? Is there a lease? What are the rental terms? And now it's an emergency exit. And of course, if we can't sell fast, it typically, as they say, the emergency exit, if it doesn't sell in the first 90 days, it doesn't sell at all. So having things like a death and disability clause, having a lease structure to separate the real estate corp and the practice corp is key. This is a great one. These are just some of the dozens and dozens of clauses that are negotiable or also very important for those of you that own. And yes, you are your own tenant. Yes, you are paying from one pocket to the other. Yes, you can play dual personalities and be good cop, bad cop with yourself because you're your own landlord. But still, you should be aware of this, looking at it through the fact that at some point between now and transitioning, you may become a full-time landlord. So, without going into each of these, this is just some of the major pieces to be aware of. Um, One example to deep dive into this rabbit hole is just where some of the 55 and a half pages of other stuff can become a major red flag. Have a 2-second look at some of the issues hidden in plain sight. So the first question we always ask, doctors coming into Cain Waters or otherwise, is, right, when was the last time you read through your lease, and or what are some of the issues that, right, may be hiding in plain sight? As Charles said, there's 2 times you look at your contracts. One is when you sign it, 2 is when something goes wrong, right? And 3 is when you go to sell. But just looking at one particular example, this is a common thread we're seeing throughout the country. Landlords are putting the options to renew into the personal name of the existing doctor. In other words, Dr. Joe Black has the ability to renew his lease for 2 more 5-year options. But if Dr. Black, heaven forbid, passes away or sells the lease to Dr. Green, right? Dr. Green does not have the same ability to stay in the space and renew the leases. Number one. Number two is you must give written notice to the landlord not less than 9 months worth of in advance. Yes, as Charles said, start 2 years in advance. If not, the landlord puts these little poison pills in there, and it's not as a negative. The landlord says, look, if you want to stay, give me notice 9 months, 12 months in advance so I can put up a for lease sign, etc. However, right, I've yet to find a landlord that proactively reminds the doctor that, hey, doctor, don't forget, you need to send me a registered letter 9 months in advance. No, what typically happens is shortly thereafter, and surprise, which is exactly what happened here. This is a doctor in Texas that got this lovely letter literally the Monday after the option to renew deadline went through. So, doctor, right, as you know, your lease expires on last Friday. Pursuant to Section 2.4 of your lease, you had an option to renew for 5 years at market rate. However, you're required to give me written notice of your intention to renew no later than 6 months prior to the expiration of your current term. By my calculation, it was no later than Friday, which you did not do. And then really adding some icing on the cake, right? Please be advised that my broker will be placing a for lease sign in a conspicuous but non-intrusive place on the premises this week. Oh, and oh, by the way, he'll only show prospective clients during business hours. So there you go. Your chair side, right? You're mid removing an impacted third, and suddenly in comes other dentists literally looking at your space. All because you missed one key KPI or one key note, which is in your phone now. Please put in when does your lease expire, right? And most importantly, when is that option to renew deadline? Ideally, you want to have a whole new lease signed before that deadline. In other words, right, how do landlords win? They simply look at this as a clock, and the longer they stall, delay, the worse it is. The best thing you can do is start that process as early as possible. And number one is get all the required documentation. The original lease that Dr. Smith signed in 1986, and is when and any renewals, riders, exhibits, anything like that is key. If you don't have a countersigned version from your landlord, you can email them tonight and say, "Hey, I'm digitizing my records. Please send me a digital copy," and they'll send it back to you within typical minutes. Number two is figure out your goals, right? Just like Charles will touch on, have challenge your professional team and have them challenge you. Where do you want to go, doctor, right? What's your production? What's your production per chair? How do you want to grow your business? Do you want to grow? Do you want to add a second location? Do you want to wind it down? Do you want to drive more EBITDA? Right. Number three is have that lease professionally reviewed. Work with your advisors, help to make sure that you know at least what's hiding in your lease and what impact that might have. Number four, as Jason mentioned, get all the facts and data, right? Make sure you work with a partner that has access to both that, proprietary and that key license data. And ultimately, right, before you do anything, really figure out what that long-term goal looks like, right? Where are we at today? Where do we want to go? And how do we bridge that gap? Right? What have we not done yet? We have not picked up the phone and called the landlord. So please do not walk into the clinic tomorrow and say, wow, I love the KPIs that Charles went through. But hey, Mr. Landlord, what do you want to charge me in my next renewal? And skip steps 1 through 5. Then negotiate the financial, then negotiate the business clauses. And bottom line, don't stop until you get to a final form lease that you are happy with. So, to summarize, and as I pass it over to Charles, we appreciate everyone's time. If you are curious for your own demographics, rental rates, right, and/or lease analysis, there's a quick yes here. In addition to that, as a lead in to Charles, is your professional team proactive with your tax planning? Right, is number two. So again, is your professional team proactive with your tax planning? Now, it's a bit of a loaded question, Charles, because, well, they ask for all my receipts at the end of the year, right? Is that proactive? Or, right, am I the one that has to say, why am I paying so much this year? And then I'm trying to literally pull teeth. So on that note, Charles, I will unshare and over to you.
Awesome. Okay.
And for those that are raising their hands that might have joined a few minutes behind, we're going to do some Q&A at the end. The chat is open. Let us know where you're coming from New York, Chicago, etc. In addition to that, we also will have the Q&A as well that we'll cover at the end. So feel free to post it while Charles runs through if you've got any questions thus far. Miss Loretto, I can see it. Over to you, sir.
Yeah, that was great. I mean, I've heard you speak before, but that was really educational for me as I think about when I'm communicating with doctors on a daily basis and just lecturing. It was really good information just to remind me on. So thank you for that. Sometimes when I'm doing a co-webinar like this, maybe somebody on the clinical side, I'm about ready to fall asleep, but that was good. Good stuff. So I appreciate that.
Thank you.
As Eric mentioned, I've been with Cain for 25 years. The firm's been in existence for a little over 41. 3,400 dental clients that we work with. This is our space. We work in the space of dentistry, marketed dentists. We've lectured to pretty much every state national meeting in the country. I've been to 60 dental schools. I run business curriculums at multiple dental schools. One of them in Texas Tech, El Paso, where I run an 80-hour business curriculum. Chicago Midwinters, the New York meetings, the Hinman meetings, I've been around. That's all I do is just talk to dentists about kind of where they are in life, what their key decisions are, and kind of guide them through what I perceive their critical path is. I'm good at what I do, but that's about it when I'm talking about this one space, talking to dentists. We love to educate. It's fun for all of us as professionals. These clients that we work with, they do travel from all 50 states to our offices. We do believe in face-to-face meetings. It does create a significant value when you can lock somebody in a room for 8-9 hours and to be able to give a comprehensive look at every financial decision they make, both at their home, at their business. We understand the business forward and backwards. And so we work primarily with owners, but we also work with associate doctors, ones that just don't own a practice yet. They need financial planning. They need perhaps student loan refinancing. Perhaps they have spousal income. They're just trying to get into ownership, but they still want some planning. We work with doctors like that, doctors that are independent contractors. Perhaps in these two stages, they're not yet pulling the trigger on their startup practice, but they still need some planning perhaps prior. And people that have obviously sold the DSOs or in a DSO in some capacity that still need planning. Just crossed over $5 billion of assets this year. So pretty incredible to see that. I mean, I've been here for a long time when I remember when we crossed $1 billion, it was a big deal, but it's quickly grown from the 2 to 3 to 4 to 5 and roughly approximately $400 to $500 million of new investments coming on the platform each year. Because investments are important. It's a big part of the accumulating assets. So we do accounting and tax work. I'm going to spend a lot of time here tonight, just on a 20-minute kind of lecture. We're going to focus on what the KPIs of the practice and what you should be challenging your accountant with. We do any type of transition work. We value businesses, represent you as a buyer to buy something or a seller to sell something. We do about 100 transactions just in that private transition services. We do accounting for over 1,000 plus. We file over 5,000 tax returns. So again, this is our space. Majority of all these doctors are all dentists. 5 quick people here. This is called the five people with stress. Number 1, a dental student, $400,000 to $500,000 of dental school debt. They're coming out, they're just trying to get a job, maybe a DSO. Stress. Not sure what to do. clinical skills are behind, stress. Number two, they do a startup practice. They get a lease at $6,000 a month, $7,000 a month. They borrow $600,000-$700,000 on their build out. They've got $400,000 to $500,000 of debt. They sign a lease, which is essentially about an $800,000-$900,000 commitment. They buy a house for $500,000. They're $2 million in debt, and we have no patience. Stressful. Number three, we finally cross over this magical $1 million collection number, but our overhead's out of whack, 65%. It should be much lower than that. They feel like they're behind. They pay cash for something. They maybe have depreciated things too rapid, and they're in what's called this phantom income, where I make the money and pay the debt, but I don't have any depreciation or write-off. And so it feels like I'm behind. Number four, I call it rich people problem number one. Number five is rich people problem number two. $2+ million practice, unbelievable overhead. What I'm going to show you here in a second is how practices grow and how we can get overheads down to these really low numbers. We can make, a really good margin. Number four and number five, doctor, here, there's stress. There's two things. They have tax problems. When you make $600,000, $700,000, $800,000, $900,000 a year, that's a tax problem. And when you make that kind of money, you want time. So when we're in that time situation for number four, creating time is now bringing on associates to free up your time, go from a 4-day to 3-day type work week on the clinic side, do some management, learn how to do that from afar. You get to that magical number five with some magical sub 50%, overhead. Could be even a consideration of selling a practice like that to a private equity group and getting some type of enterprise value of $6-7 million. Not pushing that. I'm saying that each of these people have a stress. Each of these people have an asset or a liability. Number four and number five have two assets that are both really at a high value, and it's their dental practice. So focus on these numbers, and I'll go over the KPIs for the practice here.
And Charles, not to interrupt, but just to give you some of the polls. So for those of you that might have just joined, we did some live polls. One's still up. So Charles, is your professional team and your accountant proactive with your tax planning? Only 53% said yes. And the first question at the beginning, around KPIs, 62% are not leveraging KPIs today in the clinic.
I want you to ask the proactive tax planning one more time when I'm done, because I'm going to give you what I believe is proactive tax planning. I don't think the number is going to be 53. I think that number is going to be maybe 10, but we'll see.
Okay.
So 5 different practices here. The key to this slide is this is not 3, 4, 5 practices. This is a single location. What we see on these 5 slides is something very simple. A 500 collection office is paying $50,000 yearly rent, or the rent is 10%. Take that same 4-chair practice, take clinical skills, have a great job in marketing, get the patients in, case acceptance is great, get that doctor production up by chair. We do $1 million, same practice, $50,000 rent, we drop the rent to 5%. We keep going to $1.5 million, same rent, we're at 3%. Okay. The goal that we're seeing from an accountant standpoint is to be efficient in the single location. If it's 2,000, 25, 3,000, I don't mind, leasing out a space for 3,000, but I don't want to just lease out a 3,000 square foot space as a general dentist when you've been out 2 years with no patients. It's just too big. It's too much risk to take on. I would rather us lease a space that's small, that can be efficient, be really thoughtful how we get as much as we can in there, and then we expand to the larger spaces when I have the need for the 5th and the 6th and the 7th and the 8th chair. But what you'll see is I can get these practices, and these are the accounting we do for these locations, $3 million practices. You can get the team people costs down to sub 20%. Your team 20%. 17 would be like an amazing number. Realistically, low 20s. Realistically.
And sorry, Charles, that just some questions coming through. Does that include the doctor or not?
No.
Or the associate? Okay.
And I'll show you this in a second, but when we look at a team cost, assistant front desk hygiene is all we're looking at, no doctors.
Okay.
Okay. We want to see, and I'll show the numbers breaking down with the KPIs, but you can get these team costs in the 22, 23, 24, 25%. Now, when I lecture nationally, when I say those numbers, everyone says you can't do it. Can't do it. That's impossible. You don't know my area. You don't know that hygienists are $60 an hour. Well, there's two things if you have a high team cost. This is what I can almost guarantee you. You're a PPO practice and you've got hygiene, and that hygiene model is what's not making sense. Hygiene mean you're paying $50, $60 an hour, but your hygienist is not producing 3 times what their salary is. This will create that inefficiency. So I can't solve that. I can look at numbers and tell you, hey, there's an opportunity here. Which insurance plans are you on? Let's look at the efficiency out of your hygiene department. Do we bring a hygiene consultant in? Is this a marketing problem? We need to be investing in marketing. I have a blue collar area. Okay, I get it. Blue collar area, blue collar area. You don't know my area. I'd ask this question. There's 50 dentists in your community. You're telling me that all 50, there's not one fee-for-service practice? Well, there are a couple. So 2 people have figured it out. So 2 people do know marketing. 2 people do know how to have a case acceptance assist. They know how to treatment plan. They know how to diagnose. They know how to get it done. I'm not saying 48 haven't. I'm saying I always want to play tennis with a guy or gal that's a little bit better than me, because that's how I'm going to learn, mentor, the people that are younger and bring them up and be the mentoree if you're trying to mirror something that's not working. This is not Cain Waters. We don't do this, but what we can do is do our best to look at the numbers, show you where you're high or low, and give you that confidence and give you some of those experience and stories, the consultants, to fix some of these things that can improve the practice. Okay. Here are the KPIs that we have broken down. This is a sample of what our accounting product looks like. So what we do on the target section is we actually identify what we believe you're going to hit. This is not some magical, goal. You did, 800,000 last year and you want to do 1.3. No, we're tracking your numbers on a monthly basis and can see that you consistently were doing 115 a month. That's basically going to hit you a trajectory of 1.3. So if I can see that the last several months, I'm asking questions like, are we doing fee increases? We doing anything different on the production side? The liner courses you've been taking, at what point are you going to offer those? If I know that type of data, I can set a really good target. Target is what we believe we're going to hit. I'll set that target from a revenue perspective. Now I look at your exact team members, assistant front desk and hygiene. And now, even though last year my, say, KPI for team was 27, perhaps we only did $1 million. Well, if I can take the 1 million and say we're going to do 1.3, because that's what you're trending. In the last 3 months, you've been averaging 24% team, then I'm going to forecast that for the next year. And I'm going to do that the same way and same process for lab, same way in supplies. I need my lab and supply to be, as a combined number, 10, 11, no more than 12%. And when you look at them individually, supplies need to be at 5%. That does not include an aligner case. That does not include implants. My CAD/CAM is different. My lab supply is different. If I have a CAD/CAM, I should be able to start to see my lab in around the 3% number. Make sure your blocks are put inside of your lab category, because that truly is a lab expense. So a little bit of how much was the CAD/CAM? How do we finance that? Is that technically in there? We do look at that from a technology standpoint. We like a technology, but it needs to get a return on investment. So here are, look, a 3% occupancy or 7% occupancy cost, 3% marketing. This is what we projected. This particular practice didn't spend any on money on marketing. So what does that tell you? That probably maybe a fee-for-service practice, maybe they got a line out the door. They don't need marketing. When do you need marketing? When we're trying to grow the practice. So we may set some targets, but we may not even spend money if we don't need it. If I get a 7% target on my rent, I'm probably going to be around that. It shouldn't be too much higher or lower than that, because it's a fixed cost. The point of this is you make projections for the practice on the revenue. You make projections on the practice from your direct cost, team, assistant front desk hygiene, lab and supplies, fixed costs, so I can project out what the income we're going to make. As you mentioned, Jason, this does not include doctor. We do not include it. When you value a business as a whole, you remove the doctor at all time. That means if we're going to have it valued and sold to a doctor, private equity does the exact same thing. You remove the doctor. There's a calculation to come up with what's called the EBITDA, and we will add doctor back to get what's called our EBITDA and not our profit. But for this exercise, my P&Ls, I want it clean, revenue, direct costs, fixed costs, what's my profit? Then I would add back interest, depreciation, the doctor's salary, the spouse's salary. Then I would add back, the kids. I would add back, the perks I'm running through the practice. I made 51, 52, 350%, whatever it is. Then what did I make after maybe my doctor? I could care less. If I make $1 million, 50% overhead, I make 500 grand. And after that, I paid myself 300,000 of salary. I had a pension plan of 100 and all this other stuff. And I showed a zero profit. Okay. I know that I made 500 grand because that's exactly what it said. These KPIs, these are the big picture. Then next level, you want to see the detail. So this is where I would see that detail of the $1.3 million. This is where I would see the detail of my assistant, front desk, and hygiene broken out. I want to be able to look at my hygiene salaries. I want to be able to look, now that I spent 125, I want to see what I actually collected in my hygiene department. That's probably around 6 hygiene days. If I got 6 hygiene days, what did I collect in hygiene? This data now says where we're in line or out of line. If I'm 23%, I'm probably not even looking at this. I'm celebrating. Like, hey, good job. We're moving on. If I've got a lab and supply at 6, 7%, high five, move on. If I have this practice, and this practice is basically saying I have a 48% net profit, 52% overhead. If I see this, high five. What are we talking about? What are we going to do with the 600 grand we make? That's what we're talking about. Let's
That's
tax
the tax problem conversation.
That's tax problem. That's probably needing an associate. Do you put the 5th year? Do you put the 6th year in the practice? What are you referring out? This practice is screaming, I make money once some time, and do we have room for an associate? Okay. That's what it would look like from an accounting standpoint. This right here is where I would tell you the proactive tax planning. So I want us to think about something. This practice here, the horizontal view here, let's say that I'm projecting that this practice, let's say last year we did $1 million, okay? And I think it's going to do $1 million, in 2024, okay? So what am I going to, maybe I'm going to project it's going to do, $1.1 million. We're going to expect some growth, okay? So what it's really saying is I'm going to do about 90,000 a month. Okay, so I look at it. We're on track, but I'm up 30,000. So what we need to be thinking about is now on that 30,000, are we more profitable in that 30,000? 100%. Well, my overhead is around, I'm making it up, 60%. So if I'm projecting out that you're going to do 90, and I project out that you're going to make 40% of that, that's $36,000 that you net. But what's interesting is if I can see on those months that I did the 130, I'm $40,000 above. What's my profit on that 40,000? Is it 40%? Absolutely not. Your team cost is covered. Okay, so I don't have the 23, 24. Nope. Is fixed cost fixed? It's fixed. What else do you have? You got your lab, you got your supplies, you got some, maybe some credit cards, a little bit of office supply. That $40,000 could net you 75, 80%. So now all of a sudden that first quarter, you're up $30,000+ than what you perceived you were going to be. Okay. So your accountant knows that, and it's in April. We need to review that and know that that was $30,000 of taxable income that we didn't budget. Hey, what's going on? All these liner cases are kicking in, this and that. Fast forward to April, May, and what's happening here? This practice is blowing up. the revenues are going up. Profit now has become way more profitable, these incremental dollars. We can see it through the financial statement. We've got a clear vision of it. And I need to start tax planning with that, because I told this doctor, you know, a year ago, or I told him, you know, 3-4 months before the year started. So if this is, you know, right now in October, I'm planning with my clients in 2026. We're looking at the trends here, like the October, November, December numbers, and making a projection of what these revenues are going to be. Projection of what the team and the assistant, front desk, the lab and supply, and my profit. So if I can get a visual in 2025 of what 2026 looks like, then I can set my goals. And so if I set a goal as an example, this doctor is going to make $400,000. That's $100,000 a quarter. In April, I need to look, how did we do? If we're above, then I need to tax plan with that. And what I mean by that is, we estimated you're going to make 400, and now we're up. Let's put some money in savings and leave it there. Or if we take a distribution out, let's also take a little bit of unexpected tax we weren't expecting and put that into Q2 or Q3 or Q4. To look in advance and to make this projection, now I can set in your salary, take exactly how much I need to take out, you know, for federal taxes, have your quarterly estimates dialed in. I'm looking at the practice all year, making sure you're executing the cars, the 401k and the profit sharing plan, the spouse, the kids, the retreat deductions, the Augusta rule. I'm looking at equipment decisions. Do we pay, you know, cash and depreciate it this way, so I can time it all out? I know to the dollar amount by the end of the year what those taxes need to be. Make that estimate, and we're good. Proactive tax planning is looking a year in advance and looking at it only in a quarter in arrears, and then having a final number at the end of the year. If the tax return files in April or September or October, it doesn't make a difference, because I gave the advice ahead of time. I gave the advice of what we were going to do. We hit it. We were on track. We made the adjustments along the way, and we tax planned throughout the entire year. It is proactive tax planning to see it, forecast it, and then to execute it. Okay. We have these accounting reports we do now for the first time a la carte. We can do these accounting, you know, for as little as $500 a month, $550 a month. If you're watching like, hey, my accountant doesn't do any of this stuff, I like those reports, that looks cool. That is how we can offer a relationship with you for accounting for as little as $550 a month. One more thing on tax planning. So when you think about tax planning, all of you have this asset. It's called the dental practice. All of you may have a stock, okay? These are all going to be sold, and you're going to have a capital gains tax. One day in the future, if you want to practice, you sell something, you're going to have what's called a capital gains tax. If you know that's going to happen, just like you know your lease is going to expire, it's a moment in time coming. You need to plan with that. So what we do with our clients is we utilize a tool. It's called tax loss harvesting. Tax loss harvesting is a short 60-second version. Is you're going to invest in 1,000 different stocks. Just like you would in the S&P with 500, you're going to do this with the Russell 1000, 1,000 stocks. They go like this. And what happens is, in any given year, let's say it's a good year, the market's up 10% in this particular index, not all the stocks are going to be up. There's going to be a large portion, maybe 300 of them, 30%, that actually lost money. There's a product called Canvas that we utilize. Canvas, what it does is with AI, it says, if it goes below the values, or in this case, your basis for the stock, it goes down, automatically triggers a sale. What happens with the sale? Well, it creates a loss. The loss now stays with you. For all of these individual losses, they add up, and you get a nice K1 of a loss. Immediately after you sell, you go right back into something else. It's in a simpler product. So if I can build up these losses and get this same return to the index, it's called tax loss harvesting. This is what very successful people do that pay a lot of tax. If you've never heard of tax loss harvesting, you're not getting these types of, this is going to happen, I'm going to sell my business, I know I've got capital gains issue, how to offset that, being aggressive with running all these things through the business. That's where you feel uncomfortable. And that's, if you got all those pieces, then of course, give yourself 100 for sure on your tax plan. These are the services, these are the companies we offer. If you want any type of quote unquote review of your individual tax returns or more information just on something as simple as accounting, the info at Cain Waters, you can scan the contact us, hear this up on the screen. Just say, I want more information on accounting, more information on tax. Somebody from our firm will reach out. We're not going to sell anything. We'll go over in kind of an educational story where you are and guide you. All right. So we got questions, I think, in the chat as well, Jason. So should we address those?
Absolutely. So we had a doctor ask, does team cost include payroll tax?
That's a great question. And if you download our Cain Waters how's your practice compare report, that's the one thing we do include. So team costs and payroll tax, that's it. What if we have healthcare? Nope. What if we have 401k and a profit sharing? No. Now, I've got a subcategory for that, so I don't mind it's there. But when I measure across the board, when I have all of these practices and I do this nationally, I measure with those two things. Very good question. Salary, payroll tax. Good question.
Charles, another one that came up, especially when we were down in Southern California a couple weeks ago, is the 40% profit margin came up. And to your point earlier, right? No way, right? Not in my clinic, not with my team, not with my this, not with my that. What would you do to the doctor that maybe looked at some of your numbers with an air of skepticism and, not that it's, had the hygiene costs or otherwise, but how would you help to eat that elephant for that doctor or that skeptical doctor that says, "Oh, there's no way I'll get to 40% profit margin," right? Those sorts of things. What are some key basic steps just to start that journey?
Number one, this is why I don't respond to anything on social media, because there's a bunch of Facebook people on 20, 30,000 of these population. They say all of this stuff is not possible. When our reports come out, either the orthodontic practice compared, GP practices, like, oh, that's not possible. They're handpicking all their data. It's a bunch of accountants. We're pulling the data from, the software that we do. It is what it is. I will tell you, you won't hit those numbers without focus. And if you just have a 65% overhead, it's probably because the top line is not happening. So it could be a low collection. When I refer to these margins of netting 40% as a general dentist, we need to do $1 million or greater. That's the reality. If we're in insurance, the sad thing is if you don't get out of insurance, you're just going to need to work harder. And so in that case, you're going to have to take clinical courses, a Spear or somebody like that to get your speed up. And then you got to talk about, if you're going to do that, because you're in that PPO, plan and you're handcuffed there, you need to be able to diagnose and do higher cases, cosmetic type cases, and advertise to that PPO population that you offer that. And it's not covered in insurance. If your office looks like that, where it's all this smile design stuff, the probability that some of this stuff happens is going to be great. That's where you're getting that mentor to help you, the mentoree. I go to Spear a lot and teach. Those doctors are clinically awesome. I mean, I hang out with them. I know their numbers. I do accounting for a lot of them. I mean, you got to hit with the 4 and 4 5 to get to play with the 4 and 5s. I'm sorry. And if you're hanging out with a bunch of people that say you can't do it, it's probably not going to happen.
Charles, we've got another question here.
Yes.
To me, it's an interesting one. What is the reasonable salary of a solo dental practice with S Corp election?
It's a very common question. Let me give you, the answer is this. It really depends. If you have a startup practice that's doing 500 collections, I can justify paying nothing and you're an S Corp. If you have an endodontic practice and it's only doing 600,000, but for whatever reason you have a 35% overhead and you're making close to 400 grand, then your salary is going to be somewhere around, from a tax planning perspective, 200,000. What's interesting is you don't need to pay yourself higher than $330,000. The 330 number is magical because from an IRS standpoint, it allows us to test the profit sharing plan where we get the most in for us and then a reasonable cost to the staff. We file tax returns all across the country, 5,000 to be exact. And the IRS is not coming in auditing saying, hey, it looks like your oral surgeon made $1 million. This is 330. We think that you should be paying 400 because that's what a reasonable oral surgeon, should get paid. It's just those are the questions that you would want to ask, not Facebook, but who does these returns? Have you ever been audited? What is being asked? If you've ever lost on something like that, how would you address that? So a little bit to the answer is it depends. Big question is if you make a lot of money, then that 330 is probably your number. If you're like an independent contractor working as a periodontist and just bouncing around and you only bring in 200 of collections, I don't know. You mean you bring in 400 or 500 and you need to figure out the salary, I don't know, maybe 150 or something like that. What the IRS does not want to see is nothing. They don't want to see that you take 50,000 as salary and 400 profit. They'll come get you for that. That's the serious, I'm avoiding taxes. Minimum number is probably your 150 number to answer that question.
Perfect. That's great. Some other good follow-up questions that came through there, and I just added that follow-up poll. So Charles, we'll see if it does change. I said, do you want your professional team to push you more to be proactive on your taxes and KPIs? So I think we are going to get a little closer to that one-sided answer you were saying before. Jason, there's a bunch of questions of other doctors that we help. And not just renewals, but certainly maybe at a high level, Jason, how do we help doctors, let it be relocating or opening a clinic for the first time? How do you help those doctors as well?
Yes, absolutely. So in terms of who we help and how we help, to be clear, we do not operate as a brokerage. So we're not the ones necessarily, going into the spaces with you and turning the keys. We don't, we're not paid a commission by the landlord. We solely represent the client's best interest, your best interest when it comes to the lease. And the lease can manifest in different shapes and forms. So for those that are looking to do a new start, that's one scenario. For those that are looking to simply renew their lease or expand their premises, that's another situation that we get heavily involved in. And then finally, for those that are looking to clean up the lease prior to transition to make sure that, frankly, your key KPI and your earnings remain your earnings. We have definitely a role to play in that regard as well. Even for those that own their own property, the lease is still abundantly important here in this regard because if for those that are looking to hold on to their property as passive form of income after practice sale, that lease is going to be critical to your future earnings, your future passive income, and also it'll allow you to have additional control over your future tenant, the new dental practitioner.
Yeah. Charles, anything on those lines? There's a couple of questions that have cropped up afterwards, but what are some key things you do? Let's say the doctor does want to keep the real estate post-sale, or let's say the buyer is so heavily deep in debt, the last thing they want is to pay $2 million for the clinic and another $1 million for the building. Any best practices there in terms of doctors either that own now and maybe they haven't even thought that far ahead, or what are some key things they can do now to prepare for all the options, including maybe the buyer wants to do a lease to own in 10 years or otherwise? Any thoughts there?
Yeah, so let's just for simplicity, it's $1 million, $1.2 million collection practice. The price is $1 million to buy it. And for simplicity, the building is also valued at $1 million. The doctor buys the practice. This conversation is both for buyer and seller. So if the seller says, hey, I want to sell the building, they need to know that their buyer for the dental practice alone is going to need roughly about $70,000 of liquidity, 7% of the purchase price on the million. They have to show that to the bank. On top of that, if they are to purchase the building, then they're going to need to bring somewhere around that 15% down payment, for the real estate. So most buyers won't be sitting around with $200,000 of cash to perhaps purchase that practice and that building. From a building perspective, I like it, if the seller, and for me, if I'm advising, you sell the practice reasonable, and then perhaps, I rent now to my buyer and I get a little rental income off that. But what I always tell the buyer is, the seller, don't hold on to this real estate with greed, thinking that this is going to be my retirement. I'm just going to get this $70,000, $80,000, $90,000 of income until eternity, because that tenant is going to be like, hey, I want to buy the building, and I'm just paying this $70,000, $80,000, so I want to buy it, and then all of a sudden they don't renew, and all of a sudden you're in your 70s in a different state, left with a building that's outfitted for a dentist, and maybe that market's changed a little bit. Now you're trying to sell a building that's outfitted for a dentist, and maybe there's not one that wants to take it over. So you want to get the equity out of that real estate at some point. Reasonable to hold on a little bit, reasonable to get out, and be fair for that buyer as well.
Awesome.
Actually,
Perfect.
there's another question here.
Yep, go ahead,
if I
Jason.
may. So for Charles, doctor's asking, what's the maximum dollar amount you can deduct with the Augusta rule?
So a general rule is just 14 days. In general, about $1,000. Most accountants would go with that. I mean, you get think about, like, if you were to rent basically your house out, you can't really. I don't know what kind of house you got, but I mean, about $1,000 to kind of rent something out. $1,000 to maybe rent a facility out. That's a general kind of a number that an accountant would feel pretty comfortable with. So about 14 grand.
Perfect. And then Jason, on that side, doctors looking for a space. So maybe those that joined a little bit late, we showed the software. What are some key things if a doctor came to you and said, hey, I'm looking for a space in Augusta or otherwise between 1,500 and 2,000 square feet?
Well, the interesting part is that, as I mentioned before, we're not necessarily a broker. We don't walk into the spaces with you. But, in terms of space finding capability, one of the key things that you'll need to know is what's out there, what's expected in terms of what you'll be paying, and then what's the demographic situation look like as far as the area. We help with all three of those. So, yeah.
And just to add, think of us as the key extension. We want to be you and help you. So again, we'll work if you've got your brother-in-law's a local broker, etc. No problems at all. We'll work with any of the local team, etc. Just, always important you've got someone on your side that is only paid for by you, right? Where that isn't being paid for by the landlord, etc., etc. So yeah, ultimately we want to help to be that air traffic controller, and every stage of dealing with landlord, dealing with broker, dealing with lawyer, whatever, right? We want to help to make sure to keep doctors being great doctors, and certainly help to make sure that we keep as much money into your pockets as possible. Great questions. Perfect. I know, Lynn, you had posted or raised the hand. We'll happy to keep it open for another minute or two. Charles, I know, has a very important date tonight for some
I'm
art.
good. I'm perfectly fine. I'm good.
Just teasing you. One additional one here, Charles. How do you calculate how expensive of the building you can afford to buy? We can touch on that as well, but from an accounting perspective, Charles, let's say they're in a lease or they're contemplating, do I buy, do I lease, etc.
Yeah, I can tell you one thing. We're not trying to overbuild here. The guy or gal, the 0.5% that you mentioned that goes bankrupt, it's typically a guy. Girls don't go bankrupt. It's typically a guy, and they did something wrong. And one of those something wrong is they typically just built too much. Okay, they took on too much. So I personally, if I'm going down, if I'm ever going to own a practice from a real estate standpoint, I always lease first. I don't know what I'm going to do. Okay, I don't know if I'm going to be a 6-chair. So I don't know my vision on my marketing. I just don't know. So I'm always going to lease first. Okay, I'm going to lease. I'm going to get as much dentistry as I can out of that space, and I have a bunch of money in my pocket. And then I'm going to think about, I have a 4 or 5 chair practice. So if I've got a 5 or 6 chair practice in a lease space of 2,000, I'm squeezing every dollar I can out of that thing. What's the line I've got out? Maybe doing 1.6, 1.7 out of that thing. So what's my vision and what can I do dentistry wise? The last thing I'm going to do is go build some 14, 15 practice. I'm just not going to do it. I may build a 10 and I may build a building and, maybe have a little room for a little bit more growth. But the last thing I want to go do is take out some $3-4 million loan on a building, because you start running the math and go, I need to get my rent to 5%. I got some $3 million building. Ask Chat GPT what your payments are. Ask Chat GPT the next question. So if I'm paying, $300,000, $25,000 a month in rent, how do I get my, my overhead and my fixed costs down really low, or my rent at 5? 6 million. How many doctors do you need to do 6 million? And I'm not going to bet you're going to do 6 million at a one location. I haven't seen a lot of those. So if you think you're that person, the best place to do it is 1.6 million, go here to 3 to 4 million. Worst case scenario, you're building another building at the age of 50, but you got so much money in your pocket now, it's okay. Don't overbuild.
Yeah, no, it's if we had a nickel, Jason, for all the conversations we've had on those lines, I think that the other thing to consider is look at all your decisions today based on the eyes of your buyer. And buyers these days, I don't know what's going on in dental school, but certainly all the young associates or otherwise are coming out looking for that ground floor retail, grocery anchored, lots of parking, etc. seems to be a big desire. And also it's what a lot of the big clinics are looking for as well. So, very tough to buy a strip mall. That adds to the dollars and cents, and then you become a full-time landlord. So, again, those individual type of standalone places, permitting, zonings, build out costs. Gosh, I was just in San Francisco. Their build out cost, even in a lease space, are 450 to 500 per square foot. Ridiculous, the startup costs these days. So again, you want to squeeze as much as you can and give yourself the flexibility. And certainly for those early to mid-career, that lease space can give you that ton of flexibility, and you don't have to worry about issues, right? You're not your own landlord, and you don't have to worry about a tenant coming in with a plunger and saying, "Hey, doc, right, the toilet's full upstairs," or like my own pediatrician for my kids, right? The tenant upstairs, residential tenant, leaked. Right, they had to shut down 4 operatories for almost 6 months with all the leak damage from the tenant up above. So, again, it's always an interesting conversation, but bottom line is leverage. Charles, I see here over 54%. Charles requested a follow-up call with you and the team, which is great. Similarly, Jason for the follow-up for a lease review and rent rate analysis. So, truly a privilege and an honor, Charles. We can't thank you enough for your time. This is, again, a great opportunity to add great content, great speakers, challenge the status quo. And yes, almost 93% said, yes, I want my professional team to push me more to be proactive on taxes and KPIs. So dramatically changed from what it was midterm.
Well, in the closing there, you deserve it. The bottom line of the goal of what we're trying to do is just educate you. I will tell you to remove emotion from your investment advisor, accountant, lawyers, anybody, and just best of class people around you. Always be willing to shop, always be willing to fire. And that's how we work. We're working on a month-to-month basis. You can fire me at any point. If I don't provide value, you should terminate, and it's okay. We'll hug it out, one day in the future. So, if you're not getting some of these things I'm talking about, A, consider us. B, just consider somebody else. But if you're going to your accountant with all these ideas, I don't know. Hey, doctor, I was reading online of all the things that I could, do to make myself healthier. And I know you're about ready to go on surgery on me. I think you should do this surgery versus the one you just told me. Hey, that's a good idea. I mean, are you really bringing this type of information and now trusting this person? You should be working with people proactively telling you all these things. And then you're like, oh, wow, thanks for bringing that to my attention. Yeah, how do I execute? So that's the goal. Just educate, motivate, and surround yourself with the best class people. And I mean this, you guys did a great job. It was very informative for me, and it just made me think differently with my conversations that I lead with dentists as they go through this. So I appreciate that.
Awesome. Perfect. And Jason, the best way to get in touch with you?
Yes, absolutely. You can call me at 645-333-4000. Happy to help.
Perfect. Charles, you are a gentleman and a scholar, sir. Thank you so much. Jason as well. Greatly appreciated. Thank you, doctors, for your time. You're not alone in all of this, right? Leverage the professional team, challenge the status quo, and certainly we truly appreciate all your time and have a great, profitable year.
Awesome.
Thanks very much, everybody.
Good
Yeah.
night,
Thank
everyone.
you, guys.
Cheers.